Everyday Team GCI. I'm Brad Alexander, and in today's GCI Market Outlook, let's take a look at Forex trading on gold, pound dollar, the S&P 500, the FTSE 100, the Nikkei, and the NASDAQ. The U.S. Federal Reserve lowered interest rates as predicted, but inflation is still an issue. Look what happened. Before we look at that, don't forget to like, subscribe, and get notified on YouTube, Facebook, and Instagram. After the cut, Jerome Powell announced that the Fed may slow down rate cuts in 2025, driving U.S. indices much lower. But should we buy back in? The move affected all global stock indices, and the good news is the Nikkei is recovering. It opened lower this morning, but filled the gap quite quickly. This may signal recoveries in the rest of the world. The FTSE 100 in London fell as well, but this may not be a sensible long trade as price action is in a downtrend and GBP is strong against all other currencies except the US dollar. If we look at the US indices, we have some good candidates for long trades as we see the stochastic oscillator oversold and turning up on the S&P 500 and the NASDAQ. We saw US dollar Forex pairs move in a much stronger US dollar. The big move in USD also affected gold as price action broke out of its range. It rebounded quite quickly and is back to a key level, so we will need to see where it wants to go from here. As most US dollar pairs were already moving in favor of the greenback, we only see a reversal possibility on pound dollar. On the 4-hour chart, we see the stochastic oscillator looking very oversold after the big fall. For you Fibonacci fans, we see that price action bounced off a key level and is now at the 61.8% level. Let's see if GBP buyers and/or US dollar sellers can push it higher. Speaking of the Great British Pound, let's see if today's interest rate decision, where we expect no change, causes volatility. That's all for now. CFDs and FX are leveraged products, and your capital may be at risk.